How's it going? It's Drew Blasik here. In this video, we're going to do a introduction of three-statement modeling, do something very basic, and we're going to connect the income statement, the equity schedule, the balance sheet, and the cash flow statement. So the Excel sheet's right below if you wanted to download it and follow along. Okay, so what we're going to look at here is very basic model. We got the balance sheet, so we're going to solve that first. So if you get it correct, it will light up green to show that you got it correct. So all we're going to do is we're going to calculate the total current assets, and I'm going to hit all equals on the keyboard, and that's going to sum it up. I'm going to hold down Shift, go to the right, and then Control R. That's going to fill to the right. If you're not good at that, you can hit all equals again. That's all we're doing. Next, we want to solve is net fixed assets or long-term assets. So I'm going to hit all equals, sum it up. I'm going to go back here. I'm going to hold down Shift, go to that cell, and I'm going to hit Control R. That's going to do the same equation. Next, what we want to do is find out what is the total assets. Well, total assets is fixed assets plus current assets. That's going to be our total. Now we're going to go on the liabilities and the equity side of things. What we want to do is calculate the total current liabilities, and all we're going to do is sum that up. It's very um, simple here, the balance sheet. Then what we want to do is find out what is the total long-term liabilities. Well, that's just going to be the one. We only have long-term debt. There could be other aspects to it that we have longer term. So what is I should probably explain it. That current assets is anything that would be converted into cash within a year. Current liabilities, anything that we owe our obligations within a year. And then long-term assets is anything that would be converted into cash longer than a year. And then liabilities, anything we have to pay back longer than a year. All right, go across. Now what we need is total liabilities. And total liabilities is going to be our uh, long-term liabilities and our current liabilities added up. Have it go over. Now we're going to get to the stockholders' equity portion of things. And all we're going to do here is add up what is the total equity. Total equity. So I'm going to hit sum. All we're doing is going to add up the common stock of shareholders, what they own, and retained earnings. Retained earnings is the reinvestment after our income statement. If we make money, we can pay the shareholders, the owners, or we can reinvest it back in. So we want to see what that is. That'd be the total. Now we want the total liabilities plus equity. And just remember that should equal our total assets. Total liabilities and equity should equal total assets. You see that check below. Right now we're off. That should be a line. It should be 0. So once we add these up, we did it correct, right? The check is correct. I can look at my grade. The balance sheet is completed. All right, let's get to the income statement. The income statement is revenue or sales, so it's price times quantity, and then we want to subtract how much did those goods cost to make, cost of goods sold. So what we were trying to solve is gross sales. This is important is that sometimes on income statements, the cost of goods sold is shown as a positive. If that's the case, you have to say revenue minus cost of goods sold. What I did here is I included it as a negative, which means all we have to do is sum it up. It automatically will do that minus the cost of goods sold. Now all we do now, we're going to go down the EBITDA. As we go down, all we do is we find the last calculated field, and I'm going to add, well, a couple ways we could do it. I could do the sum. I could do the sum function, and then I'm going to hold down Shift and just highlight those. So what we're doing is we're doing the last calculated field, subtracting out the other expenses. Now we want to find out operational income. Operation income, that's EBIT, earnings before interest and taxes. What we have to do is we have to subtract out depreciation. So all I'm going to do is hit the sum function. I'm going to hold down Shift, and I'm going to highlight the last calculated field, which is the EBITDA, and I'm going to subtract out the depreciation. Depreciation was never a direct outlay of money. We're doing that for tax purposes to have our taxable income lower. So we want to make sure that this was never something that actually costs us a direct outlay of money in this regard. Next is our interest expense. So I'm going to equal, so I'm going to sum that up. I'm going to highlight that. So next is taxes. Now this gets a little more difficult. Now typically the taxes, and what I have in the assumptions page, I have our tax rate of 21%. Um, so taxes, now typically you would multiply to find out how much you paid in taxes. You multiply the EBT, the last calculated field. This is our earnings before taxes. This is our taxable income. And you multiply it times 21%, and that's going to be our amount of taxes we pay. However, if you notice in 2024, we lost money. So what that is, that's going to be zero. Okay. That's going to be zero. Now you have to think about is, well, how much taxes are we paying in 25? Now, if I take the taxable income of 25 and I multiply it, I'm going to go to our assumptions page. I'm going to hit that 21%. Well, that's incorrect. It's incorrect because there's something called a carryover. If I lost a certain, let's say I made $100 this year, and if I lost $50 last year, I can carry that over, and my taxable income becomes, I know I made 100, but since I lost 50, I subtract the 50 from my 100, so my taxable income is actually lower. So what we're going to do here is I'm going to go equals, I'm going to bracket this, and I'm going to hit, well, this is my taxable income, but I get to subtract out that negative EBT that we had. Now, since this is already a negative, I'm going to say plus that, and then I'm going to multiply that times our tax rate. So now that's the amount of taxes we paid. Now, I could do a more complicated if function saying if, for example, if this amount is negative, I don't want to do, I just want a zero. Or you could do a min function in that regards. Or and then in 2025, you could say if, I'm not going to do it for this video, but I'll do it for the next video. If this amount is great, I'm sorry, if the previous year had a zero tax rate, that means what I want to do is I want to take this minus that. And if not, I'm just going to take that taxable income. So there's different ways you could do it. I'll show that in the next video. Next, we got net profit. Well, I'm going to take the last calculated field. And you notice how taxes is not negative, how I calculated it. So now I have to hit a negative because I have to subtract out the taxes. So we'll go across. All right. So now let's go to our statement of stockholders' equity. Now, just a note, so I'm taking the PowerPoints and I'm putting them in one Excel sheet so we can see how everything is connected. One note to make is that if you're doing financial modeling, you need to solve the equity schedule, all the schedules, and then typically what we'll do is we'll plug those in our forecasted in our balance sheet. I'm not doing that. The balance sheet is already solved, so I want to take what we have in the balance sheet to try to figure out the stockholders' equity. All right, first thing I'm going to do, this is 24, this is 25. And another note, this is how the PowerPoint had it, that typically the years go further on the other way. So this would be 24, that would be 25 typically. So what we want to know is what is our ending balance of our common shares of stock in 24? So I have to find that. Well, I moved it. That's going to be in our assumptions page. And I have it right here. So the number of shares outstanding in 24, that's our ending balance. And this is called the corkscrew technique. So the ending balance of the previous year becomes the beginning balance of this year. And it makes sense, right? I'm bringing in 100,000 shares. Now we have to kind of calculate this. We have an issuance. Now my assumptions page would typically show that, but we're going to calculate this in a different way. Is how do we find out, did we issue new stock? Did we raise money? Well, I need to find out. Now, typically you would look that up in the assumptions page and then you would sum it up for the ending balance, right? I take the beginning balance plus the addition and I sum up the ending. But what we have here in our data is I'm going to go back here. In 2025, the shares outstanding are 250,000. So what that tells me is how much do we issue? What do we add any shares? Do we issue new shares to raise money? Well, to find that out, that's going to be our ending balance minus our beginning balance, right? We added 150,000 shares, and that's what we did to raise money for our uh, capital expenditures that we did. Um, so we had to raise some cash in there. Okay, next, common stock dollar amount. So what I'm going to do is I'm going to find 2024, the previous year, the ending balance. So we're going to go back to the balance sheet. And that's going to be that 460,000. So that's going to be our common stock dollar value. This is what the shareholders own in the equity of the company here. So the beginning balance would be the ending balance of the previous year. So we're going to corkscrew that in. That's just going to come in. And now what we want to know is we want to know what is our ending balance and did we have an additional stock to the shareholders? Well, as you can see, we did issue new shares, so we're going to have an additional through the new issuance of common stock. So if you go to the balance sheet of 2025, because this is already completed, that's the ending balance, right? That's the ending balance of 24. This is the ending balance. So we raised funds through issuing 150,000 new shares, and now we increased that amount. Okay, to find out how much money we raised, we know the ending balance is 25. Well, it's just going to be the difference between the total of 2025 and I'm going to subtract out the beginning balance. So that must be the additional issuance of stock. So we raised 150,000 shares, got 1.258 million. Okay, next what we want to find out, what about the dividend payout rate per share? So first off, I want to know our shares outstanding. I'm going to go to the assumptions page. That's going to be right there, the 250,000. And I'm going to go over. So this is an investment we have to make. In order for people to buy our company's stock, we put in there, we said, we will pay you a dividend. We want to know what that dividend is. And then that's going to cost us something. So let's find out what that dividend payout rate, that's going to be in the assumption. So dividends per share, that's what we want to look at. Dividends per share. There's the 2020 5. Now that I need to correct. So what we're going to do is on your sheet, this will be corrected. Decimal. And I'm going to put that as a currency. So it's 22 cents per share. Now here's a little trick because how it was set up in the assumptions page, we have 2024. So I'm just going to go over Control R and then we have the 0.11. All right, so now we want to know, well, how much did this cost us, right? We had to raise new funds. We have to pay the shareholders a dividend. So what we're going to do here is I'm going to take the 22 cents, I'm going to multiply it times the 250,000. So it cost me $55,000. Now, if I did the same thing here, this is where it gets a little tricky. That's incorrect. And the reason why it's incorrect, if we go back to the income statement, this is an important note. Common shares only pay out dividends typically. Only pay out dividends if you make a profit. Now, typically it's based on how much money we made. Now, what we did was we did it per share. A lot of times it could be a certain amount multiplied times the net income or a certain percentage of the net income. But since we lost money in 2024, unless this was preferred stock, we're going to put down a 0 because we lost money. So that's the important part to learn about common stock. Next, we want to know retained earnings. I'm going to do the corkscrew technique. I want to know what the ending balance of 24 is. Well, that's all in the equity portion right there. I have retained earnings. We're going to pull that in. The ending balance will become the beginning balance of the next year. So I'm going to pull that in. Now, okay, so I always mention this in my class. When you have net income, let's look at this net income real quick, or net profit, same thing. Net profit, net income, same thing. We lost money, so there's nothing we can do with that. However, we made $260,000. There's two things you can do with your money. If you made money in your business, you either could pay yourself or you put it back into the business. So, in regards to retained earnings, that's reinvestment into the business. So, we have to know, did they pay the owners of the company, which are dividends? And we have to know the net income or net profit, and we have to know. Then it will tell us how much retained earnings we have. So let's look at this. So if we're bringing in $32,592, well, I want to know how much money did we make this year? Well, that's the 260,000, right? Now, next thing I want to know is, well, did we pay a dividend? This is important because there's two things you can do with that 206,000. That's not going all to retained earnings. 55,000 of it, I believe I put as a negative. So put a negative. 55,000 of that is getting paid to the shareholders, which means the ending balance of retained earnings must be the retained earnings you're bringing in from the previous year plus the money we made in 2025 minus the dividends paid, right? If I took that 206,000 minus the 55,000, that's the additional retained earnings. So I'm just going to sum that up, and that's the 238,465 that we have, and that's correct, 238,465. All right, on to the next thing, statement of cash flow. Just a reminder that the income statement is not a correct, doesn't show you how much money you actually made. So I want to spend a little time on the statement of cash flows is because depreciation was never a direct outlay of money. So I'm going to have to add that back in to see how much cash I actually have. However, we want to know also people buying our products on credit. Did more people buy it on credit? Because if they did, I don't have that money today, right? I have to wait till next period. Or did less people buy it on credit? If less people bought it on credit, I have more money today. More people are paying cash. Or what about accounts payable? Do I owe more money today? Am I taking more loans out today? If I'm taking more loans out today, liabilities, I have more cash today. If you go to the bank and you issue $1 million loan, if you need $1 million loan, you have $1 million more cash today, but your liabilities went up by $1 million, but you have $1 million more cash. So what we're going to do here in the statement of cash flows, we want to find out through operations, investing, and financing, how much money do we have? So let's plug these in. First thing we're going to do is bring in the net income. Where's that located? Again, net income, net profit, same thing. That's found on the balance sheet. Next is depreciation. This is going to be a positive amount. I'm going to make sure I always do positive or negative depending on if it's a inflow or an outflow of cash. So I want to know depreciation. So we're going to go to the income statement. Well, how much do we spend in depreciation? So see how that's a negative? So I'm going to go to that formula bar. I'm going to put another negative to make this a positive. What we're doing is we're going to add in 116,000 because it was never, we only subtracted it because of tax purposes. I wanted to lower my taxable income, so I have to add it back in. Now, this is where a lot of people have issues with. This is important. When we talk about liabilities, if your liabilities goes up, your cash goes up, right? If I take more debt on today, I have more cash, right? I took a loan out today, I have cash today. If my liabilities goes down, right? If you owed $100,000 and I used all my cash to pay off my debt went down, but my cash went down. So liabilities is a direct relationship. It goes up, cash goes up, goes down, cash goes down. However, assets are the opposite, right? Inventory is the easiest way, I think, to think about it. If you increase your inventory, you have to use cash to buy inventory. So if your inventory goes up, your cash goes down. If your inventory goes down, I'm selling through inventory and I'm not replenishing my inventory, my cash goes up. So assets is a indirect relationship or a negative relationship, and it's a positive or a direct relationship when it comes to liabilities. So we want to know it's accounts payable. That's a liability. So we want to know what is the change of, and I got to change that. It says increase, but that's the change of accounts payable, what we need to know. So what we're going to do is I want you to get into the habit. I'm going to bracket it. There's no reason to do it liabilities, but I'm going to do it so get in the habit. And what we're going to do is we're going to go to the balance sheet on this. There's accounts payable. Do you see how from 24 to 25, our accounts payable went down, which means our cash went down. Liabilities went down, our cash went down. I use my cash to pay off that liability, so I have less cash. So what we're going to do is, all I'm going to do is take 25 minus 24. So since it went down, my cash value went down by negative 87,000. What about the change of accruals? So what we're going to do is, again, I'm going to bracket each one. So you have to look at where's accruals. Well, accruals is a liability. And you see it went from 49 to 408. And again, my liabilities went down. Therefore, my cash went down. So all I'm going to do is take my 25 accrual and I'm going to subtract out my 24 accrual. So my cash went down by 81,000. Now we want to know, what about the change of accounts receivable? That's an asset. What's accounts receivable? That's when customers come into your shop and they owe you. It's a credit, right? They bought 100,000 worth of goods, but they're not going to pay you till later. So if the change of my accounts receivable went up, my cash goes down. However, if all the customers decided not to buy credit, and my accounts receivable went down, my cash goes up because everyone's paying cash. So this is what I'm gonna do. It's a negative relationship. So I'm gonna put a negative sign and then I'm gonna bracket and do the exact same thing. So we're gonna go to accounts receivable, that's AR, and you gotta make sure it's bracket. So I want the negative, I wanna flip that. So our cash went down by 245,000. And then we want to know, what about the change in inventory? Like I already explained, inventory, it makes sense. However, it's an asset, so it's a negative relationship. I'm going to put that negative, bracket it, go straight to inventory, and I'm going to subtract that out. All right, now we want to know, what is the net cash provided by operating activities? Well, all we're going to do is sum it up. We have net income or add back depreciation, and then we had all those changes in our operational income or net working capital. So we want to know, well, we lost through operations a negative $466,000, which is not good. Next is investing. I want you to think about investing. I want to think about, if you want to buy a rental property, you buy an asset, you buy an actual house. That's an investment. We're not looking at, this is not financial investments like 401k, stuff like that. So what we're looking at here is, did we add to our property, plant, and equipment? What is that? That's fixed assets. We want to know, did it go up, our cash value go up or down? So what we're going to do, I'm going to hit equals. Let's go find where that's at. Well, that's going to be found in the balance sheet, the net fixed assets. We have property, plant, and equipment. Okay, so this is important. A lot of people get confused on it. You see, now it's an asset, so it runs off the same thing. It's a negative relationship. So before I explain it, I'm going to put a negative sign. I'm going to bracket it. But you see how our property, plant, and equipment went from 1.2 to 1.197. So it's like you owned all these properties and you sold a couple. So I don't own as much. It went down. If I sold it off, what happens to cash? It goes up. So again, that goes down. That's going to be a negative. So if I took this value minus the previous year, it's going down. I have that negative sign because an asset's a negative relationship. It goes down. My cash goes up. So investing aspect. So it looks like, to raise funds, because we're losing money, we had to sell off some of our property, plant, and equipment. Now we're just going to get our total. All it is a sum of what we just did. All right, last what we want to do is financing activities. So financing activities, that's going to be our debt. That's going to be not the accounts payable, but that's going to be our notes payable, our long-term debt, and then also an investment activity. Okay, there's two ways to raise money. You sell equity, you sell the company, part of the company away to another owner, or you take on debt. That's both considered a financing activity. So we have debt, and then also dividends is considered that. That's important to see. So I'm gonna go equals. Let's go to notes payable. That's gonna be on the balance sheet. Liabilities, there's notes payable. That's short-term debt, anything you have to pay back within a year. So we're just going to find the difference between the current and the previous year. Again, it's a direct relationship. You don't have to do the bracket on this one. It's probably good to get into the habit. So our debt went down. Therefore, we used cash to do it. So our notes payable went down. Let's look at long-term debt. How did that happen? Is that what it might be funding everything? So our long-term debt went down as well. It went from 723,000 to 400,000, which tells you we paid off a lot of debt, which must have come from cash. So our cash went down. Dividends, that's always going to be an outflow of cash. That's always going to be a negative. So I'm going to go equals. I'm going to find the dividend payment. There's two places to find it. We have the dividend there. I'm going to take this one because it's already a negative. Proceeds from issuance of common stock. So to raise funds, this is considered part of the investment, right? To raise funds, we had to issue new common stock. So we want to know how much money did we raise from issuing the 150,000 shares? Well, that's going to be right here. That's that 1.2 that we figured out. And then all we're going to do here is all equals, and I'm going to sum those up. So from financing, so we're actually getting out of debt, and looks like what we're going towards is selling stock, selling equity to raise funds. So that increased it by 543,000. So next what we're going to do is we want to know what is the total of cash flow. So I'm going to go equals. I'm going to add up the financing activities. I'm going to add up the investing activities, and I'm going to add up the operational activities. And then that's going to give us our total cash flow. How much do we add to our free cash flow is 83,449. Again, the income statement does not tell the whole picture, the whole story. We have to find out through the cash flow statement to see how much cash do we really have. All right, so what I want to show here and to prove how this works is this is a little summary thing. I want to know what is the cash at the end of the year? What is the cash at the beginning of the year? So where's that found? Where's cash found? Well, that's found on the balance sheet. The balance sheet shows assets, the current assets, and it's based on liquidity. So the most liquid asset is cash. So we want to know what is the beginning of the year. So I'm going to go to the balance sheet, and we brought in 7,282,000. You see how it went to 90,000 there. So all I'm doing is adding that. And then it wants to know what is the cash at the end of the year. Well, that's just going to be our 2025. That's the 90,000. It's already solved for us. But what I wanted to show here was, well, what is the net increase or decrease in cash? This is important here. So you should catch on right now is that if we increased it, if we had 7,282,000, we want to know how much cash do we add to the business. Well, we have to go to the cash flow statement. That's going to show how much cash we added. 83,000. So it's already solved on the balance sheet, right? So if I find out the difference from this year and the previous year, that number should equal the 83,449 because that's how much cash we brought in for the year. Last parts here I'm going to do is this is through the other data, other stuff that we want to calculate. We want to know what the market value is. So let's do this really quick. Market value is just the price of the company multiply times how many shares outstanding. So what do we have here? I have the stock price here. I'm going to put that in. Oh, what am I doing? And I want to multiply times the shares outstanding. So I'm going to go back to the assumptions, 250,000. That's the market value. That's what people value it. The market value is what the shares outstanding and the price. That's what people are willing to pay for the company today. So that's what it's worth. All I do is drag it over. That's going to give what the market value. So the market value of the company did go up. Next, we want to know what is the book value. Well, the book value is we want to know what is the total equity of the company. That's the book value. The book value is the total equity on the balance sheet. Market value is what people are willing to pay. Book value is total equity. So I'm going to go to that. I'm going to drag that over. Oh, if you ever make a mistake, like I just did, hit Control Z, it backs it up. Um, so you don't have to worry about it too much. Next, what we want to do, so we know what the market value is and what the book value is. The book value is on the balance sheet. Market value is price times shares outstanding. Then we want to know what is the market value added. That's just going to be the difference between what people value the company and the equity of the company or the book value. So the market value added is just the difference. And you see 24, we were negative, which means people valued us less than what was on our books. You definitely want a positive value there. Okay, next what we want to do is we want to solve what is the net working capital. These are just some equations here. Net working capital, all that is going to be our total current assets minus our total current liabilities. Why is that value very important? Is because that number tells you how healthy the business is. Do they have enough money coming in through? This is through our cash to be coming in this year. That's going to be converted into cash to pay off our current obligations. So if that number is getting close to zero, we're in trouble. If that number, as you see, the year before, we're in big trouble, 276,000. Now we're at 1.5 million. However, if it is negative, we don't have enough money. It's bankruptcy. Now we're looking at net operating working capital, and all that is that's going to be a little different. So I'm gonna bracket that. What that is it's a better tell. Are their operations bringing enough money to pay off the obligations? I don't like to include the excess cash in this regard. So what we're going to do is we're going to take the total current assets and I'm going to subtract out the excess cash. Why? That's not part of operations. We want to know, is our inventories and our AR, is that bringing enough money to pay off our obligations? So I'm going to find that out and then I'm going to subtract out. I'm going to go to liabilities and we're going to take our total current liabilities and all right, so I want to make sure I have some issues there. Okay, so all we're going to do here is so I took that and I'm going to subtract out our, oh, why is this showing up here? Oh, there you go. All right, so I'm sorry. I had a little, so I'm going to take out the notes payable right there. So I'm going to subtract out that. So that just really shows our accruals, our accounts payable. Those are through the operations of the business. Notes payable is just a debt that I had, short-term debt. I want to know accounts payables, like if I'm a business owner, I owe to other businesses. Let's say I work at Lowe's and Whirlpool shipped in a bunch of washers. I owe them accounts payable at the end of the period. Do I have enough money if we take out the cash and the debt to pay off? So are our operations actually um, working properly? So that's what that is going to be. There you go. If you did all that and you have it all green, you are 100% on the right path. So if any questions, please let me know. Again, the Excel sheet is listed below to follow along. In that, I highly recommend if you're in accounting or finance, you save this document and you can always review it if you get confused. And you could play around with it. You could do a lot of things. You could take certain things out and say, well, how do I solve it? You might have to solve it a different way um, than the way that I just did it. So God bless. And any questions, please send me a message.